Hey guys, it is December 5th and we are in the holiday season. Today I'm going to talk about Qurate, ticker QRTEA, but first we're just going to set the markets up as per usual. All right, I'm going to share my screen. Past performance is not indicative of future returns. And even though I'm going to be talking about stock I really like, you got to make your own investment decisions, due diligence, my friends. Here's the market as it stands today. It's weak today for some reason, and as David will talk to you later, it is hitting a lot of buy signals for the technical folks. For me, I don't know that it necessarily deserves to be this week because, and I'll show it later this week, I'm not seeing bad earnings reports from people. Like I'm seeing it be about where it was last quarter, but I'm seeing the market continue to sink. I think that's a little bit aggressive. Um, Crude oil started up on the day and then just started to sink every so much. So it's really hard. I think we need one more day to really tell if there's just something weird that the traders and the day traders want to do. If we look at the heat map, you can see that the largest components, Apple, Google, a bunch of that sold off hard last week and in weeks past, it's kind of pausing here and just down a touch. Tesla being dragged downwards by fake news, quite frankly. And it's hysterical because if you look at Yahoo Finance, it's this article, Tesla denies report of China output cut as deliveries hit record. So you got a situation where reporters are coming out and telling you that Tesla is decreasing production for some reason in China. And that's despite the fact that one, they actually increased and had all-time record outputs. And two, they're telling you that ain't true. And three, it just doesn't make any sense because we're still in a massive shortage for new cars. And four, and this is the most important, they don't really sell most of those cars in China. They're actually shipping those overseas. We've talked about this. I have no idea why Yahoo Finance, they just do not follow the rules of most news organizations. So take that as it will. Now you'll notice that whereas before it would get beat up even more aggressively than this on a numerical value, this thing isn't crossing into the lands that it was crossing in before. I think that I think the shorts are getting tired here, and the people that would like to buy it are concerned that they won't be that the price isn't going at much lower than this. And in fairness, from a valuation perspective, that's true, for lack of a better way to describe it. But we'll go through that some other time. There's enough videos I've made on Tesla at this point. Um, Okay, let's get into it. The economic data is the last piece that we'll go through before we get into this stock. If you look at it, there's news flow that suggests that the economic data is what's pushing the market down. I don't buy into any of that. PMI is not enough to take this market down because what we've been seeing across all the purchasing managers indices is mixed results. One is saying up, the other saying down. We know it's the end of the year, so any kind of intelligence we're going to get right now isn't very helpful until we get into the next part of the year. ISM services, same thing. Factory orders coming in better. So you've got two down, one up. This isn't what should drive the market. So that as an excuse, there might be someone coming out of some positions, et cetera, but nonetheless. And then I think the stupidest or craziest, I really shouldn't be so critical, thing I've seen is that this is all about weighing in on economic data that comes in this week as if this economic data would do it. It would not. Let me be very clear. Productivity, none of this. Consumer credit, maybe, but no. None of these are really meaningful data points that should jog the markets any way, shape, or form because they usually require that you have more than one on any given one of these. Maybe PPI on Friday at 8:30, but this is the final demand number. So, it's already more or less known as well. So with that, just know that this market's going to continue to be volatile. There's a lot of things that happened, especially at the bigger houses, where they're going to have to rejugger different things going on in the way that they've asset allocated. Not the least of which is these huge asset managers like BlackRock, which now currently have seem to be getting into it, let's call it, with other very large asset managers. And we as the individual investor just have to stay out of the way and take opportunity where we can. Now, I will be doing a Christmas list. Let me just say this is a little promo. I will be doing a Christmas list of stocks at different price points. I will have a $5 list that comes out first. And as such, this video is intended to give a little bit more detail on a company that will be on that list, Qurate Retail Group. Let me tell you about Qurate. Very interesting company. It was spun out of Liberty Media Liberty Global. And so the history of this Liberty Media, Liberty Global Group, these are some of the biggest billionaires in the United States of America. So it is worthwhile, if you're a super nerd, to go all the way back to the initial spin out of all these different pieces. Expedia spun out of Liberty Group. All kinds of companies spun out of Liberty Media. Qurate is the retail piece. And so it includes things like QVC, Zulily, things like that. I'll show it to you in just a second. But what happened with them and why they become really interesting, because you'll look at the valuation on the data feeds like Yahoo Finance, and you'll be like, she lost her mind that she's suggesting this? And the answer to that is no, I have not lost my mind. Let me tell you the story. Okay. They had a big, ridiculous fire that happened at their Rocky Mountain facility, and it has caused nothing but trouble. There's been a few different things that are related to it, including they've switched up the management team. They brought in this wonderful gentleman. I think I have a slide on him. He comes from Nielsen. I actually have been following his career since he became CEO of Nielsen IQ, I believe is what they had eventually called it. And then after the deal went through and Nielsen got split up, Qurate more or less grabbed him. So now let's go into the financials as to why I think this is one where you've got a little bit of time to buy it. Anyone going on the data feeds is going to get it wrong because they need to know the story to make sense of this data. All right, let me share my screen again. Here we go. All right, these are the brands that Qurate, let's call it, traffics in. These are ones they own. They own the Home Shopping Network. They own QVC and QVC International. And then they own these home goods, mostly companies. Frontgate, if you've ever flown in an airplane and you're not really young, and they used to have those things that were in the seat cushion, you would have seen what Frontgate was. They're usually selling very specific things for fancy people in their fancy homes, for lack of a better way to describe it. And then you've got Garnet Hill, Brandon Road, and Ballard Designs. That's the retail that's owned by this company, Qurate. And then on the QVC and things, I know not everybody's watching QVC. Believe it or not, these brands are sold on QVC. You can buy yourself a Shark vacuum, Bose headsets, Benefits, all these really great brands absolutely are found on QVC. Now, the ones that I really want you to take a look at is Zulily. I'm going to show you this in just a second, because Zulily has been a massive earnings laggard, and they've changed up management of pretty much every single piece of this business. And, inventory is what inventory is, and companies are what companies are. But I think Zulily is the one that is not completely baked in at this point as to whether there's upside there. So I'll give you that hint. If you're going to do work, QVC, HSN, they've already turned the corner and moving forward. Zulily has a new management person coming in, and you're going to really want to watch what she does and accomplishes to get that business turned around. But if we go into the quarter, this is what the financials look like, and why I'm actually very sure that if you're doing this purely off of data feeds, you're going to get this story as wrong can be. Now, I want you to keep in mind when you're looking at a company like this, you want to know what the market cap is, okay, which is $940 million. And then because of the nature of this company and the fact that they've had a couple of series of things that happened before this year, you're really going to want to be thinking about this in terms of enterprise value, okay? I got a whole video on enterprise value versus EBITDA. But what you're doing with enterprise value is you're acknowledging the fact that a company's got a lot of debt whenever you're doing valuation work. And so what you do with enterprise value is to take the market cap, which is the equity value people are paying on the stock market, then you add in the debt. And the debt approximately, let's just call it approximately, is 5.3 billion, meaning that right now the market is valuing this company at $6.4 billion. Well, how much do they do in sales? The answer to that is, even with this craziness that's happened on the completely burning down of their Rocky Mountain facility, they managed to do $2.7 billion worth of sales last year. All right. Now, if you go to the data feeds on Yahoo Finance, et cetera, you're going to get an operating loss of 2.6 billion. But let me tell you why you should ignore that. The reason you should ignore that is because of this item right here, impairment of intangible assets. That is a non-cash charge that they take, essentially, to get it off the book so that they can move on with their financial statements going forward, but also because it means they didn't pay taxes this year because they didn't have to, because they took a loss. Okay. That is the smart, correct, and right thing to do when you've got a new CEO coming in, clearing the decks so that he can create a company going forward that's very profitable. So if you take this $3 billion back in, and you put it back down where it belongs because it's non-cash, you have about an adjusted net income of $400 million. And like I said, that means that on a net income basis, 6 divided by 4, this thing is trading at 12 times earnings. Okay, but it's trading at 12 times earnings. It fixed its factory situation this year. And so realizing that that factory situation cost them about $400 million worth of sales. Interesting, right? Okay, now let's go through the other parts of the numbers that make this even more exciting. All right, here's the cash flow statement. Again, you can see the impairment being added back in, because what we always worry about this whenever we see a negative net income, we got to go to the cash flow statement and see if they got enough cash. Okay. Now, already here on the income statement, we know from this impairment, they probably got enough cash just by adding them back in. But we want to make sure that everything else is cool as well. And we go to the cash flow statement. Not only do we have this impairment bringing the cash back in as we would expect, but the thing that actually took this net cash provided by operating activities into negative is this right here: an increase in trade accounts payable and an increase in accrued and other liabilities. Now, what does that mean? This is what it means. Last year, pre-fire, let's call it, they made about 715 million in operating income. That's cash. All right. That comes in, pays your bills. All right. This year, if you take these two line items, which are essentially a prepaid expense, in other words, I went ahead and paid down things that I owed in the past and now I don't owe them, or alternatively with accrueds and other liabilities, I paid back things for the future that I'm going to make money off of, provided the business continues okay, which I think it will. If you add that back in, that's $837 million. So you then subtract the 37, you actually have an operating cash flow improvement. And there's lots of reasons why you would do that. Some people might fight me on it. Nonetheless, if we're talking about, let's just use 770 million, then this thing is trading at 8 to 9 times enterprise value to EBITDA. What is that? Enterprise value I calculated for you over here. That is 6.4 billion. EBITDA is the earnings that they have, the adjusted earnings, removing the impairment, right? 400 million, adding back in all that stuff. Anyways, the point is you got EBITDA. So you got sorry, I'm doing this wrong. Adjusted EBITDA. So adjusted EBITDA, you're going to take the operating income, adding back in the impairment. That's 400 million. And then you're going to remove the DNA from here. DNA is 371. So you get about $770 million of adjusted EBITDA. The adjustment here, I'm just keeping it simple, adjusting for the impairment. This thing's trading at 8 to 9 times enterprise value to EBITDA. Okay, how's that compare to other retailers? Well, Walmart trades at 18 times, TJ Maxx trades at 18 times. Most of your retailers are going to trade at 18 times. This company's trading at 8 to 9 times, but we've got a lot of evidence that it's going to turn the corner pretty aggressively. Now let's keep going here. Here's the balance sheet. Ain't nothing wrong with this. There's nothing wrong with this. This asset impairment cleans up a lot of stuff. You can see that asset impairment here in intangible assets not subject to amortization, 9.3 down to 6.1. Okay, that's where it shows up from all the other statements. I'm connecting it on through. And then working capital, which is current assets minus current liabilities, is extremely positive, right? You got 3.5 minus 2.7. You got almost an 800 million in working capital. That is a big deal because this is a retailer, right? So that's 800. They got a lot of wiggle room to play with here. And that's just wonderful. Additionally, I want to show you that the debt has been paid down this is a pretty aggressive debt pay down. This is 300 million, which is about 8% of their debt they paid down. And that's despite the fact that they're still in this turning around situation where they got to get that Rocky Mountain facility to start producing. It is what we're seeing here. And it is producing enough cash to start to pay down that debt. All right. That is a big deal because basically when you got a retailer that's doing this, it's clearly not, there's a little bit of a game that you play as a fundamental person is which valuation is the valuation that this thing has plummeted to when it's been clobbered. And it's not a PE valuation because the market cap's only 900. So clearly people are concerned about the debt and they're concerned about some of the things that have happened. And then when they look at the earnings, that's the wrong number. So the valuation that really demonstrates where this thing is going is enterprise value to EBITDA. The interesting thing with enterprise value to EBITDA, when you have a company that's generating enough cash to pay back its debt, is that the enterprise value will shrink aggressively, making that multiple really, really small. And that enterprise value is shrinking because the company's paying back debt faster than investors are coming in and giving these guys credit. So that's why I want this on your radar screen whenever the market's red. All right, let's go back to it. There's a couple other things I just want to share with you. This is free cash flow. Okay, there are two wonderful things that you can do. I never think you should take my word for it. You should go onto their website. It's a wonderful management team that's in place right now, and you should listen to what they have to say. But this to me was the money slide that they made. This was the operating cost pressures that we see going forward. Okay, you've got operating costs, but you've got actually what was a tailwind last year being a little bit helpful going forward. Namely, the biggest one is your freight charge. Okay, they're seeing that come in. It came in pretty readily for them in the last months before they had this conference call with investors. Some of the inflation is improving. And remember, the way that they sell things, they are going to benefit if China reopens and then we start getting exports coming in from Asia. So realize that's the case. So these things that were tailwinds may actually provide upside going forward, but that's not what they're banking the whole company on. And then inventory has normalized. If you look at the balance sheet, that inventory wasn't a problem, and so on and so forth. So definitely listen into the two calls. There's one that they do on the quarter, but then because they're also Liberty Media still owns a bit of this company, they are a part of a larger Liberty Media co-branded event to talk about the companies, and their CEO gives a really great description of things. The last thing I'm going to say, and part of the reason I chose is David Robinson's a Black man, and I would love to see him continue to have a great career. I think he's really, really talented as an executive, and that it was demonstrated in how he helped to do a pure banking job, which was what needed to happen as you took Nielsen IQ and it got out from under Nielsen to now be owned by the private equity folks. So I think he's talented to do it. In fairness, this is the first retail company that he's done, but I've seen nothing but competence from him as far as resume goes. So that is another thing to note, because really it's about him navigating like a rock star and leading the ship a certain way. And with that, let me hit the pause. Any questions? Hey, Dee.
Hey man, okay, that's a really cool company.
Interesting. It's interesting, right? Look, this thing could go to 1 before it goes to higher than 2. So you want to give it time. But like I said, this is part of the Christmas list, right? And it is $2.34 or something, $2 and well, it's got some volatility to it. Let's call it that. So it's going to trade right now between $2 and $2.50. So try to find yourself a place in there. But
I've got it $2.17.
Yeah, $2.17. You buy yourself a pack of gum.
QRTEA, right?
QRTEA, that's right. That sounds right to me, because I usually put limit orders in and just see if I get
right. What was that again? QR what?
QRTEA. But this thing will trade crazy, D. So please don't think that I think that this is 100% a buy. I think it trades crazy for the next quarter. And then we'll see how they do in the holiday season. We still, like, Zulily was down 36% on sales last year. I looked at the Zulily website. I'm not necessarily Zulily's market. They really market, from what I understand, to new moms. And so they do a lot of stuff that's for kids that you're not going to buy Canada Goose, because there's no way your kid isn't going to grow out of it in half a year. So they'll sell a different brand that looks a whole lot like it cosmetically, but is not going to make you want to cry as soon as your child grows. So but have a look and see what you think about Zulily, because I think Zulily is the piece that will surprise people if the woman they put in place can get it turned around.
Okay,
I'm gonna check it out.
Cool. What else? Sorry, other questions?
No, I mean, they should have a big holiday season, right?
I'm hoping they will. I'm hoping they will. Now, the bears are going to be telling you that nobody shops on the Home Shopping Network anymore because it's moving to streaming. And it is the case that Home Shopping Network has several streaming channels, and that they are partnering with like Netflix and the such. Now, do I think those partnerships are great or whatever? To be fair, I don't know, because you still have to go, you have to click off Netflix and click onto the home shopping network if that's your deal. But what I do think is that people that tend to like the home shopping network, they buy from the home shopping network, whether it's streaming or not. So in other words, they might, so they partnered with Netflix on Stranger Things. And so they have all the items from Stranger Things available sometimes on, if you wanted to get them. I don't know. I don't know how to think about it, but they do have about 90 million people that watch them. Crazy.
Okay, we just hit our target on the S&P, so
Oh, okay. So hopefully we'll have a green Christmas.
yeah. Yeah. Okay. Thank you, man.
Anyways, that's all we got for today. Everyone's sick. I mean, I don't think there's no real news flow. Anything you're reading, just take it with a grain of salt right now, because when there's no news flow, you get these news networks just making stuff up more or less just to try to drive it. All right. Bye.
Thanks. I'm about to watch the replay. Appreciate it.